Okay, I think we are on time, so we are going to get this going. My name is Tim Fortin. I'm from Cordis Asset Management. On behalf of the company, I'd like to welcome you all this morning to our webinar on positioning your portfolio for phase 4 of the market. Now, there's a lot going on in the world right now, from the terrible events that are happening in the Ukraine to the fact that COVID-19 just won't go away. We've got huge growth in inflation that we haven't had to deal with for some time now. And we've got super low unemployment rates. And all of this is bringing us to ask questions about where exactly are we at today in the market and what are the implications for our portfolio. So we've got our friends here from Piper Sandler that are going to share their thoughts and ideas on exactly that. So before I switch it over to them, I just wanted to provide a short background on Cordis. Cordis Asset Management follows somewhere in the area of about 100 stocks from the medical technology universe. From here, we choose 25 to 40 that we actually include in the Global Medical Technology Fund. Now, our team is focused very much on identifying not only the technologies, but the companies that are best positioned to benefit from the global healthcare megatrend. Now, healthcare spending, as many of you would know, is at record levels today. It's approaching or over 9% of gross domestic product in OECD countries, and it's at 17% in the United States. So you think about that, 17% of the world's largest economy is going into healthcare spending today. And the rate of growth in healthcare spending is actually outstripping that of GDP growth in pretty much every developed market in the world today. So when we consider that, there is a lot behind that growth. So demographics, certainly not the least of which, when you consider the fact that we're aging and we're aging fast, and we've had huge growth in the middle classes right around the world. And as middle classes grow, so does the demand for healthcare and quality healthcare. So that's really part of what's pushing this growth along. So there is no slowdown happening in healthcare spending. And if anything, it's about to accelerate and continue to accelerate for some time. And the fastest subsector of growth in healthcare happens to be medical technology. Now, at Cordis, we take a pretty unique approach to how we choose the companies that do make up our portfolio. Firstly, we have the traditional approach, that's with research and investment analytics, but we complement that with our medical advisory board. Now, this is an in-house team of physicians that actually use these technologies around the world. And we also have a team of investment or medical technology experts that are very familiar with commercializing these technologies. So it's a very, very unique team that we have. So there's a lot happening out there. MedTech's a very exciting industry. It's a great place to be. Cordis is in the middle of it, and we invite you to join us on that journey. Now, please feel free to reach out with any questions or thoughts to Cordis directly. Now, also, if you have any questions directly related to the webinar that you're on now and the content you're going to be seeing, there's two ways that you can send those questions in. One, you will see that there is a chat button on your screen, so you can tap that. That'll go into the public forum. You can also email me directly at tim.fortin@cordisam.com. So on to the main event. Our guests for today are Michael Kantrowitz and Emily Needell, calling in from the East Coast of the United States. Thank you very much to joining us for your evening and our morning here. I'll hand it over to you both for a brief introduction so you can let our audience know who you are. But just before you do that, I'm going to get compliant for a moment and remind our audience that Piper Sandler provides advice for institutional investors. They are not a registered investment advisor, and they do not make recommendations regarding the purchase or sale of specific investment funds. So we are covered. With that, Michael and Emily, I'll turn it over to you.
All right. Thank you very much. And it's our pleasure to join you this morning or this evening for us. Again, I'm Michael Kantrowitz. I'm the Chief Investment Strategist at Piper Sandler, joined with Emily Needell, the Deputy Chief Investment Strategist at Piper Sandler. Emily and I have worked together for over 12 years at a few different firms, all very macro focused. Piper Sandler recently acquired Cornerstone Macro, which was the firm we were at for about 7 or 8 years, which we formed back in 2014. Prior to that, we worked at another firm called Wolf Trahan, and before that, ISI Group. But all macro, all day. We're both chartered financial analysts, the CFA charter, and we've both been working in portfolio strategy for almost 15 years. Anything I missed, Emily?
That pretty much sums it up. A lot of macro for many years.
So Piper Sandler Macro, which again was just acquired Cornerstone Macro, our firm does research from economics, policy, both looking at central bank policy around the world, monetary policy trends, as well as government and fiscal policy trends, things that are going on in DC and around the world. We also have an energy-focused team that covers the macro outlook for the oil and gas sector, as well as technical analysis. So we very much cover the major pillars of macro. And we're happy to be with you today to share some of our views on where we are in the market cycle and where we're headed and what that means for the equity markets. So just, I'll start off here and I'm going to pass it on to Emily. Right now, we've been in a recovery globally since March of 2020, when all central banks and governments threw a lot of money at the global economy. And the past 2 years, although there's been some fits and starts because due to COVID, the global economy today is looking at a snapshot of economic data and earnings data. The global economy is fairly strong. We're dealing with a lot of different cross currents, from inflation to a tightening cycle in central banks to higher interest rates. Higher mortgage rates in the US are causing some concern for the housing sector. And you'll see why in a few slides why that matters to us. But where we look at the market cycle, which is different than the economic cycle, within an economic cycle, which is defined by the recession, market cycles can happen several times between recessions. In other words, earnings can recover, accelerate, slow down, and then re-accelerate. And you can see this pattern play out a few times before an actually economic downturn. So what we're going to be highlighting is something that's really often measured in 3 or 4 years rather than 8 or 9 years, which in the US has been the average number of years between recessions. So we've put some dates on this 5-phase market cycle that you see on the cover of our handout. And the title that we're now focused on is the major turning point in the market cycle and what that's going to mean for investors over the next year. We have, again, come out of a really sharp global recovery beginning in early 2020. Last year was one of the strongest years for earnings recovery and earnings recovery in decades. And we've got a lot of inflation. A lot of central banks have raised rates. And what we're concerned about and where we think investors should start to look and shift their portfolio into areas of the financial markets that will offer more stability, stable growth, and visibility, like healthcare, is where you want to be when we start to roll over into what we call phase 4. And phase 4 is where you are moving past the peak in leading economic indicators in earnings growth and the peak in GDP growth. And so what we are expecting over the next 12 to 15 months is a global slowdown that is going to be met with fewer positive earnings revisions, increasingly more negative earnings revisions, and likely a lot of companies that are going to miss their earnings. Estimates are extremely high in the United States. Market earnings are up 5% from where they started the year. And we believe that investors are extrapolating the past year rather than thinking about what all of the ramifications of higher rates, central bank tightening, inflation mean for the market. And what that always means is slower growth. It takes time for higher rates and higher inflation to translate into slower growth. But it's been a story now. It's been taking place for about a year and a half. We've seen rising rates and inflation. And we're at the point now where you're going to start to see the impact of that on earnings in the economy. And so we're going to illustrate what this means for the markets, but we focus a lot on leading economic indicators of the economy. Specifically, we look at PMIs, or Purchasing Managers Indices. Just about every country has one of these. Most of the developed have them, and most emerging economies have them. They're great, high-frequency, real-time indicators of economic activity. They're diffusion indices, so they tell us if things are accelerating or slowing. It's not going to be like GDP, where you get a specific number. It's more of a diffusion index. And why we use these three charts, I think, illustrate why we focus so much on this and ultimately forecast these trends, is that they help explain market returns. In fact, if I zoom in here on this cover chart, this top chart here, right here, and this is a chart of the ISM index, a popular leading indicator in the United States, and the year-over-year return in the S&P 500. And just simply, you see that when the economy accelerates and the ISM goes up from low levels, that is where you tend to see your best market returns. That's the last 2 years. That's largely behind us. And as PMIs begin to slow, that's where market returns tend to decline and potentially even go negative. And that's what we're starting to pick up today. If earnings were so much stronger, this pickup in interest rates that has pulled down multiples wouldn't really matter that much. But because we're now slowing, any pickup in interest rates can have a pretty violent move on the market. And so the reason there's such a good correlation or relationship between the ISM and the return in the market is because there's a lot of different earnings data that analysts and investors look at. But we feel, and this chart illustrates it, that the ISM is a great macro insight or macro lens into what consensus on Wall Street, how they're shifting their earnings expectations. So this chart here shows the ISM, once again, with the percentage of earnings revisions that are positive from all the S&P 500 companies. We add them all up together. And so you can see this macro data series is a pretty good way to explain how consensus earnings shift. So when we look at the ISM today, it's sitting at about, if you look at the right scale, it's sitting at about 61. Our forecast is that's going to 45 over the next 15 months. And so what that suggests to us almost always is that we're going to see a very different earnings picture over the next year and a half, especially very different compared to what we've seen in the past year and a half. And so what happens when earnings start to slow? Well, market returns start to stagnate and slow down. And in addition to that, it often gets credit markets upset. And that's when you start to see wider credit spreads or tighter financial conditions. That's also not usually a positive for equity markets. So this chart here on the right, again, shows this proxy of the economy, the ISM, with credit spreads inverted. And what we're trying to highlight here is when the economy slows, credit spreads on the left scale start to go up. And that's investors starting to price in more and more risk. That tends to weigh on equity multiples. And so just to bring this all back to the top level here, when the economy slows, market returns slow, initially because earnings start to decelerate in terms of expectations, and then eventually credit spreads start to widen and weigh on market multiples. So that's how you get a backdrop where investors start to move their money out of very cyclical parts of the market, cyclical parts of the economy, and into areas of the market like growth, stability, and eventually defensive areas of the market like consumer staples and utilities, as growth slows further and further. And so how do we forecast these trends? And why do we believe that we're heading into a 15-month slowdown? Well, the reason we have a business cycle or a market cycle is largely due, in our opinion, to the volatility in the cost of two things. One, measured by the cost of money. So that can be measured by the change in interest rates, the change in short rates from central banks, mortgage rates on the long end, money supply growth, the yield curve, all these popular metrics that people look at and investors use to forecast the cycle. Right now, they're all pointing to a slowdown looking out the next year and a half. The other cost, which most consumers will certainly understand, is when oil prices go up, gasoline prices go up. the cost of living, essentially, things that weigh on our wallet from everyday expenses. And so certainly today, we not only have higher interest rates, but we also, of course, have higher inflation. So this is as broad-based of a slowdown signal as it gets. And so let me show you a couple of these charts. And again, I'm showing that dark line there is the ISM index. And remember, when that goes down, it means fewer positive earnings revisions, lower market returns, and wider credit spreads. And so all this inflation we've had for the last year and a half, I'm going to zoom in on this chart. This is an indicator that leads the ISM by about 2 years. And what you see is that 2 years ago, inflation, think about March 2020, there was no inflation, it was deflation. The global economy was shutting down, rates were going down. And if we fast forward 2 years later, today, we're seeing a pretty good global economy because over the last 2 years, all of the benefits of lower rates, lower inflation have helped to lead the economy to a recovery. Of course, the end of COVID in most countries around the world, COVID going endemic, has also obviously helped us, as that's been a big governor on growth. But what this chart shows is that all of this inflation over the last 2 years is just about to show up in weaker economic activity and weaker earnings. The analogy I like to give to clients is that when you eat a big meal, you don't stop until you're full. By then it's too late. And what happens an hour later, you get a stomach ache because there's a long delay in when you eat and then when your brain processes that. And then, oftentimes people overeat. And so it's the same way with the economy and the Fed. The Fed in the US is known for raising rates just a bit a few too many times. And then they have to quickly cut rates as they send the economy near a recession. So all of this takes a while to digest and show up. And so in the last year, we have seen many central banks around the world increase interest rates. The US, the Fed is just starting to, but most emerging economies and other developed economies have already been raising rates prior to this year. And so this is a chart that shows the impact of all those rate hikes. And again, we're just looking at how many countries around the world are cutting rates or raising rates. That light blue line illustrates where we are today. And on net, because just about every country has been raising rates, it is pointing to a slowdown, again, with a 15-month lead. Historically, this is a really good signal that we're going to slow down. Of course, higher rates eventually bring about slower growth. And then lastly, in the US economy, the housing sector is really the ultimate leading indicator. In fact, and I think it's especially important today where so many investors are confused because there's so many different cross currents going on and arguing that this time is different and this cycle is going to be different because of COVID, because of the war. And absolutely, there will be differences. That said, there are many more similarities in every cycle than there are differences. And you don't want to just throw out the playbook when there are one or two differences, even as extreme as they are today. And this chart is the reason, a great example of why. This is a chart, again, as a leading indicator of the US economy and leading indicator of earnings. It's housing. It's looking at the housing market. And we're looking at just basically how housing investment in the US economy is growing on a year-over-year basis. And over the last year, though it's strong in the US, housing is strong, it has slowed. And looking where mortgage rates are today, I would guess it's going to continue slowing. So that light blue line, once again, is pointing to a slowdown. Housing as a forward-looking indicator has correctly forecasted every single earnings downturn in the US since 1960. So it's happened in periods of hyperinflation, periods of deflation, periods of war, periods, you name it. It's happened. And this indicator has worked because housing is an important driver of US confidence, US consumer spending. When people feel good about housing or see their home prices appreciating, they'll often spend more. So there's of course a huge multiplier to owning a house. Anyone who owns a house knows that it costs a lot of money to maintain it. So it's a big multiplier. But unfortunately now, given mortgage rates, that it is pointing to a slowdown. And so I'm going to pass this on to Emily. But again, I just want to go back real quick and just what are the key points here I wanted to get across? We're heading into phase 4, the beginning of a PMI and earnings revision slowdown. And eventually, this could lead to wider credit spreads later this year when growth around the world slows further. And so, Emily, I'm going to pass it to you to talk about briefly some of the investment conclusions to that story.
All right. Let me see if I can you stop sharing so I could just grab the screen?
I can flip the slides if you want.
Yeah, it's not letting me grab it. So if you wouldn't mind just flipping for me. All right. So as Michael said, we spent a lot of time forecasting PMIs. We've also done extensive analysis in terms of studying PMI cycles as a blueprint for sector, industry, and factor rotation around the cycle. And not every cycle is exactly the same, but as Michael said, there's certainly patterns that generally play out. You see a lot of similarities from one cycle to the next. And so one way to illustrate the spectrum of cyclicality in the market can be here on the slide that Michael's got pulled up here. What we're looking at this chart on the left is the correlation of each sector to the US PMI. And we're looking at the 5-year correlation of relative performance. So within here, what we're seeing is that the triangles represent the median of each sector, and the bars represent the dispersion of stocks within it, the opportunity set. And so what you can see here is that the sectors that are on the top left of this chart are the ones that are most countercyclical. Those are the sectors that generally you would expect to do well when growth is slowing and PMIs are falling. And of course, healthcare is right up there with the other defensive groups. On the bottom right, you can see the most cyclical sectors. These are the sectors that have most positively correlated to PMIs. So these are the areas that you would expect to underperform in a backdrop of slowing growth. So that's more of what we're thinking about for the next several quarters. And so we've done a lot of analysis to map out both sector and factor rotation. And just before we get to the factors, I just want to show you this chart that Michael's pulling up here. This is the ISM New Orders Index, the chart on the right here on page 7 in blue, lined up with industrials relative to healthcare. So two sectors lined up with each other, industrials being a classic cyclical, healthcare being more risk off. And you can see that when PMIs are falling, you would expect industrials to underperform healthcare. We would also expect the other cyclicals to underperform healthcare and the other defenses. And so we have very high conviction, as Michael was saying, in that slowing PMI story for the next several quarters. And so with that, we believe that risk off is going to have many quarters ahead of outperformance. And so really, when it comes to what drives sectors, we put a lot of emphasis on factors, and we look for sectors that have the factor traits that we're looking for in any specific phase of the cycle. And so this slide here on page 8 maps out which factors typically do best in each of the 5 phases of the cycle. And so where we are now, we've seen a peak in growth. We are expecting to see a slowdown for the next several quarters. And so being in phase 4, we're looking for stocks that have high profitability, high earnings growth, and positive earnings revisions. And the reason being, if we're going to be in a slowing growth backdrop, you want to be more profitable. You want to be looking for, as growth becomes more scarce, investors pay up for earnings growth where they can find it. And so that's why we call this the growth phase. Growth typically does well here because it becomes more scarce and investors bid it up. And then we're also looking for stocks for factors, stocks that have positive earnings revisions. We want to see who's got that strong momentum there. We do think that we're going to see defense, an evolution of defense as we move through the next several quarters. So we're more in the growth phase now. We expect to get increasingly more defensive throughout the year. And so that's just kind of the way that we think about in terms of which factors we want to be in each of the phases. And the factors that we like helps us to determine which sectors we like and which industries we like for each of the phases. And we can drill a little bit more into the industries. This is that same analysis done. We've got the 5 phases laid out here with just a few of the key industries that have the traits that we want in each of those 5 phases. And what you'll notice is that here in phase 4, there's a number of healthcare related industries that are the ones that we pick out as being good places to be here in phase 4. You can see the 3 at the bottom of the list: life sciences, tools and services, healthcare providers and services, and equipment and supplies. All industries that have the traits that we're looking for here in phase 4. And we expect that healthcare overall is going to do well basically from here until the next, throughout the rest of the cycle, healthcare being an area that does well in the back half of later parts of the cycle, we would expect that risk off should be attractive to investors until we get to that next recovery. And then when we start all over again, and we're not expecting that to happen until really 2023. So here on slide 10, we've broken out for you within the healthcare space, the dispersion of macro sensitivities. So healthcare is a risk-off sector, but it's a relatively diverse sector. This is that same analysis we showed earlier at the sector level, but done for the subgroups within healthcare. And you can see at the top of the list here are the groups that are the most countercyclical. At the bottom, you've got the groups that are more cyclical in terms of sensitivity to PMI, but there's a very big dispersion in terms of the stocks within it. You can see those blue lines that represent the range of correlations within each subgroup are very wide. And so it really makes, it's important to be within healthcare specifically because it is has some dispersion here. You want to be picking the right stocks within the space, and there's a lot of opportunity for outperformance, for the people that are looking for the stocks that have these traits that are primed for this phase of the cycle. And so I want to conclude with one final chart on the healthcare sector. Healthcare is a sector that has the most stable earnings of all the sectors. We on the team like to break down earnings returns into those that come from PE and those that come from earnings, changes in earnings. And what you see here on this table on the left is what we've done for the healthcare sector. So every year we've broken down its returns into those that come from multiple expansion or contraction and change in earnings. And what you see is that every single calendar year, healthcare has seen a rise in NTM earnings. It's way more stable than for the overall S&P 500, which are the two charts on the right, and certainly more stable than the cyclical sectors. And so where we are now staring at a sustained slowdown, healthcare has a lot of attractive traits given that it's got that stability and it's got that the breadth in terms of opportunity set within it. And so we think that there's time to be looking at healthcare. And with that, I'll pause and see if there's any questions.
Great. Thanks very much, guys. Really appreciate that. Look, the takeaway on the final point that I really pulled out of there is healthcare in general can be a great defensive play. Solid earnings always continues. But as you dive deeper into the subsectors of healthcare and medical technology itself, you get exposure to growth. So it's quite a good balance there. So we're getting tight on time. We've got a bunch of questions. For those that we can't get to on this call, we will respond to your questions on email. So let's get to two of these. The terminology around inflation has changed over the past 3 months. How long does non-temporary inflation usually last? And I'm sure you guys have been asked this one a few times because we're just not used to this space, right?
Yeah, non-temporary inflation. I guess that's, don't want to use the word transitory.
Good.
No, this current inflation backdrop is extremely complex because you've gotten a chunk of it can be explained, especially in the US, by a huge demand surge that we saw last year when the US government gave most US consumers a chunk of money to spend. At a time where a lot of people were not working or working from home. And so you had a supply shock and a demand shock at the same time. And so actually, and I would add a third point to that, we were also in the midst of a huge recovery, which obviously the reason we had such a sharp recovery, part of it was because consumers got all that money. So there's aspects to the current inflation backdrop that, you kind of have to separate commodities from wages, from currency-induced inflation. So at Piper Sandler Macro Research, we do believe that we're pretty much nearing the peak of this inflation scare today. We're about 4 or 5 months past the peak in the market cycle. So we've started to see a global slowdown. It's early in its infancy, but between the slowdown from all the reasons I showed earlier, from higher rates, the impact of gasoline prices rising and giving me less money to spend elsewhere, demand should start to decline with the cycle at a time where in the US, COVID is fairly become endemic at this point. And so we're going to see a lot more people come back to work, especially the youngest people in the United States, where wage growth has been the strongest, been hardest to hire these young people because they all got money and bought Bitcoin and bought AMC stock or who knows what else and made a lot of money. And I guess I can imagine people thought it was easy to be an investor up until this year. And so we do expect to start to see inflation pressures peak. In fact, in the US, if you look at the producer price index, that is just 2 months off of its highest reading. That tends to lead CPI by about 3 months. We've got extremely high inventory levels in certain areas of the US economy, like retail. And we're beginning to see used car prices start to come down. So remember, inflation's year over year. So in order for it to stay high, prices have to continue to accelerate at this same rapid pace to stay at that number. And we're beginning to finally see early evidence that we're roughly at the peak. Now, is it going to drop to 1% tomorrow? No, it's going to slowly grind lower throughout the year. And adding to that disinflationary pressure around the world is the Fed's raising rates now. That's strengthening the US dollar. That can often be quite disinflationary for other economies as they get kind of squeezed by their weaker currency or the impact of a stronger dollar here. But in the US, at least, that would lead to slightly slower inflation. So commodities will be the last part of the story probably to roll over because there is a demand component, and the global economy, again, right now, and probably for the next few months, is still going to be fairly strong. As it starts to weaken, though, that inflation pressure should begin to dissipate.
Got it. Absolutely clear. Okay, look, we're a bit over, but I'm going to jam one more question in because it's a good one. We've been speaking about phase 4. What are the early warning signs that we're going to head into phase 5, and what do we do about positioning there? So that's a beefy one, but I'll put it out there to wrap this session up.
Yeah, we've been trying to be very clear about our current outlook that you don't want to be very defensive right now. Like basically, it's too early to position for phase 5. When we look at market performance, it tends to trade fairly closely with leading indicators. Markets tend to be very reactive. And so as the data slow, you will see earnings revisions eventually start to come down. And then, in 3 or 6 months, people will start to worry about growth. There's a lot of talk about recession, but you don't hear too many investors really positioning for a recession yet. And so we think that's all largely ahead of us, but you have to slow down before you just go into recession. You don't just wake up one morning and you fall into recession from a strong economy. So the leading indicators would be PMIs coming down initially, earnings expectations starting to come down. And in the US, almost, pretty much the antithesis of growth is small cap value. And in the US, small cap value earnings estimates are flat on the year. They're not going up. Whereas large cap earnings, companies that are higher quality and more growthy, are still going up. So we tend to see small cap value as the canary in the coal mine, as they're always first out of the gate to recover. Small cap value earnings quickly recovered in April and May of 2020. Large cap earnings didn't recover for about 6 months later. And they're beginning and have begun to slow over the last 3 months. So maybe we have another 3 months of earnings revisions in large caps that are positive, but when that eventually gets to large caps, we believe, or as that happens, we'll see a pretty large shift in leadership into growth. And again, so we're just starting this slowdown story, and it's got a ways to go. So you definitely want to be patient and not get too bearish too soon, even though the end of the story does end up with a fairly bearish conclusion. But we've got a ways to go.
Got it. Well, Michael, Emily, thanks very much for your time and spending your evening with us here down in Australia. Really appreciate that. And to our viewers, thanks very much for your attendance. And again, if there are questions that you'd like to forward to us, we will be sure to respond to you. Better still, give us a call. We'd love to talk to you. Thanks, everyone. Have a great day out there. Bye.
Thank you.